Thank you for joining me today. Over the next 30 minutes, I'll guide you through the essential of mutual fund investing and share the practical insights to help you make smarter decisions. And so for this, I have a plan to explain what is mutual fund, the basic of mutual fund fundamentals, and what are the types of mutual funds available with us for investments. And then types, as I said, various types of mutual fund like equity mutual fund, debt mutual fund, and then your hybrid schemes. Post that, we will discuss how SIP works, the systematic investment plan, and the benefits of investing in mutual fund through SIP. Right? So why SIP is so important. So we'll discuss that in detail. Post that, we will be discussing some of the common mistakes done by the investors so that we can understand and we learn from others' experience and we avoid those mistakes going forward. And finally, we will discuss a couple of points in what are required as an investor for a long-term success in your investing journey in the Indian stock market in particular. Yeah, thank you so much for joining me. Let's get started. This presentation is basically brought to you by my firm, an investment firm called Growtech Capital. We are also available very much in YouTube with the name NetInvestible as the channel name. We are a financial services company. We are an AMFI-registered company. So what is a mutual fund? In a very layman, in common language, mutual fund is an investment wherein the fund manager, the company pools money from various investors like you and me. We invest in a particular scheme every month through SIP, right? So all those money are getting pooled in a particular account, and then the fund manager of that particular scheme use that fund and invest in various securities depending upon the type of scheme, whether it's equity, debt, or a hybrid combination of both of these. So fund manager would invest those funds into stocks, bonds, and money market instrument and other asset classes. Now, out of those investment, whatever return the fund gets, then that particular return will be then passes back to the investors, as in us, whoever investing in a particular mutual fund. So that is the fundamental of how it works. And then who basically does it? The asset management companies facilitate those. They basically operate through those particular mutual fund schemes. So we have more than 47 AMCs, asset management companies. Motilal Oswal is one of that. And then, of course, who is the fund manager? Fund manager is the person who is qualified and SEBI certified professional who knows how to manage your money, where to invest in a particular market cycle, and they understand the market and the company is better than definitely us. Now, every month, whatever you invest, a particular unit of a particular mutual fund is being allocated to you. So what are units and NAV? So when you invest, you get a particular unit of that particular fund. So it's nothing but let's say a number of shares. What you get a share of a particular mutual fund scheme. So that we call unique in the finance parlance. Now, what is NAV? Net asset value is basically calculated on a daily basis for a particular scheme. So generally speaking, I'll try to explain what is NAV. NAV is, let's say, similar to equity. Let's say you are buying Infosys share in the secondary market. So you buy Infosys one unit of share for 1,000 rupees. So that is the price of that particular company as a share. Now, for a particular mutual fund scheme, when you buy one unit, whatever amount you pay, be it 10 rupees, 20 or 100 rupees, we call it NAV. Now, NAV, how NAV is derived, how they calculate NAV. So NAV is basically the total asset of the mutual fund scheme. Asset means whatever investment they made over the period of time in a given date, minus the total asset minus the expenses like exchange fees, annual maintenance charges, professional management fees. So minus all those charges, whatever is being left, that amount divided by the number of outstanding unit of that particular scheme, right? So whatever units of a particular scheme is being allocated to the investors. So that unit is the divisor, and then we get the value of NAV every day, whatever the NAV of a particular fund in a given position, right? So that is NAV. Now, making them we know mutual fund is a very popular choice for beginners, even the seasoned investors, because people do not have time these days to invest to research on a particular investment product or a company or any of those asset classes. So they go and they prefer having a professional manager who can manage their money and invest their money on their behalf. So that is why mutual fund is being so popular these days. These schemes are being operated by AMC, as I mentioned. Broadly, if you see the types of mutual fund available in the market are broadly categorized as equity mutual fund, debt mutual fund, and hybrid mutual fund, which is nothing but a combination of equity and debt both. So we will discuss this in detail in our next slide. These are the types of mutual fund. So equity mutual fund, we know predominantly invest their money, the fund's money, into the equity of publicly listed companies in India. Now, based on the type of scheme and objective of the scheme, fund manager buy the investment accordingly. Let's say for a large cap dominated scheme, they predominantly invest in the large cap companies, right? So the companies with high market capitalization in the Indian market, Indian stock market, and then accordingly mid cap stock, mid cap fund, small cap, flexi cap, which is basically, the fund manager is little flexible on which categorization should they go, and they have the flexibility of moving their fund between large cap, mid cap, and small cap, and such. And then multi-cap fund. Multi-cap fund is basically it's a mandatory for the fund manager to basically allocate a certain amount of fund into large cap, mid cap, small cap based on the scheme's objective. So it's basically a multi-capitalization fund. Then under equity, we have tax savers also, ELSs. We have 3 years lock-in for this kind of tax saving funds. So, and these are also tax efficient. You can claim tax benefits out of whatever amount you invest in these kind of mutual fund schemes. Then under equity, we have broadly thematic, sectoral fund, the fund which are basically cover the a particular theme, like automobiles, like BFSI, right? The real estate. So this kind of theme or sector they cater to, and every mutual fund house, every AMC has certain amount of thematic or sectoral fund being offered. Then we have value fund, focus fund, index fund. A lot of these equity oriented funds are available for you to invest. Then coming to debt instrument, debt mutual fund. So basically, predominantly they invest in the government securities, corporate bond, government bonds, which are secured, as compared to the equity investments. And then a lot of debt fund also include money market securities like short-term fund, overnight funds, etc. So these are the types of investment in a debt mutual fund, but primarily they invest in the treasury bills, which are government securities, then commercial paper of companies, certificate of deposits, etc. Then the last category, which is basically hybrid, as the name suggests, it's a combination of equity and debt instrument. So we have many funds which are being basically offered and suggested to the people who gradually moved on in their career, their mid 50s, let's say 45 plus or something. So they want to now cover their risk very efficiently, so that they're not aggressively betting on the stock market, but they still have certain element of their investment into equity market plus the debt market. So that's a balance of both of this kind of asset. So basically the part of the asset allocation works very good with the hybrid fund. So we have a couple of funds there: multi-asset allocation, conservative, aggressive hybrid, equity saving, and arbitrage fund. So these are the there are a couple of many other schemes available, the type of funds available, but these are this slide cover almost all the categories we have right now. Systematic investment plan. What is SIP? Right. So generally speaking, SIP stands for systematic investment plan. It allows you to invest in fixed amount at a regular interval, usually monthly, into a mutual fund scheme. So it's a very efficient way of saving your money, and basically inculcate a very good discipline of investing and saving. So a couple of benefits of why using SIP as your investment method. So first, definitely it inculcates very good discipline, and invest and save regularly, encourage regular saving, right? So, and it's also mitigate the risk associated with the market timings, because you yourself is not investing into the market directly, and you are, most of the people, let's admit that, do not know when to enter, when to exit the stock market, right? So the onus of taking a decision when to leave, when to enter the market is being left to the professional, experienced fund managers. And you also avoid the market timing, because every month through SIP you are buying the units of mutual funds. So that also come to the next point, rupee cost averaging. The advantage of SIP is also that it's versus the lump sum investment, wherein you invest just once, sometime the high value amount into the mutual fund. Here you are doing it every month, so you get the averaging. When market is down, you buy your mutual fund units cheaply, because market is down, and of course the NAV is associated with the market return and the market price of the underlying share within the portfolio of the scheme. So you get the NAV cheaper. So that is another advantage of investing through SIP. Then of course the power of compounding. As long as you go and do SIP and continue to do that, the compounding works wonderfully, because one is your rupee averaging cost, and then definitely it's also making a habit that every month you are investing some amount through SIP. So This way, you ensure that your investment is being compounded at a very good pace. Then, of course, we already discussed investments are managed by professionals. And of course, in today's world, the investing is so automated. SIP is one of that symbols wherein all your investment are automated and being debited from your bank automatically through various payment types, right? And it's very easy to invest. And you talk to your advisor and you get couple of schemes, mutual fund schemes, well diversified schemes, added to your portfolio, and then you continue to continue to invest through SIP every month, and it's one-time effort. Otherwise, on a regular basis, it is not worrisome. It is not hard work at all. It's all automated and very easy to invest every month. So these were a couple of benefits of investing through SIP. Mistakes that we commit over time in our investing journey. First is, of course, having no clear goals. How much you need to invest, you don't know, because without a financial plan or a specific goal, it's really a shortcoming that you have no vision how much you need to. It's like scattered. Your decisions are not, tunnel focused, and it is, you are just doing it for, without any goal. It's like you're going without a direction. It's very difficult to really be disciplined in this case. Second, of course, focusing on past performance. So most of the mutual fund investors, particularly the self-help people like who just think that having a platform, having a demat, open a mutual fund account is all you need to invest. Nothing else is required other than that. So what they do, they go and invest in the mutual fund schemes who have performed very well in last couple of years, 3-4 years. And that became the benchmark to assess a performance of a particular mutual fund for them, which is absolutely a mistake, because similar to how stock market works, we know it's a cyclical in nature. So in a particular cycle, particular sector will do good and the other sector will definitely underperform. Similarly, here in the mutual fund schemes, not all the schemes will perform well in a given. Professionals, the managers, fund managers understand what would be the right kind of scheme in a particular given point of time in the market based on the cycle. So this is very important point that one need to note, and do not focus much on the past performance. Then next is not diversifying, concentrating too much money in a single fund or in a few funds, which reduce the benefit of diversification. We know the importance of diversification. We cannot have all our money into one asset class or in one particular scheme. So diversifying between various kind of asset which has different objectives and different investment assets in their asset category is of paramount importance. So we need to also be avoiding this not diversifying thing. Then trying to time the market. So if we do it ourselves, we always try to buy at the lowest point of the market and we want to sell it at the peak, but it never happens. We know it's not possible. So that mentality we have to do away with, and we have to switch to something called a patient investor. Be a patient investor and keep investing your money over a period of time, not just once, and do not try to time the market. Just be on the market and spend time there. Be patient. Then the next point, in investing in the wrong fund. So taking too much risk. I know people, I have seen my clients, my new clients investment, they're too much skewed toward, the thematic funds, the sectoral funds, the very short-term money, the short-term view they have. And they, somebody must have told them, go to pharmaceutical, go to healthcare now. And they would go and buy all the schemes there in that particular sector in mutual fund, and they will definitely mess up with their portfolio for sure. So we need to be very balanced. That is why asset allocation comes into the picture, and the professional managers know how important asset allocation is and how to diversify and then mitigate the risk associated with the equity market. Then of course, if you do not have, if you are on self-help, then definitely every 6 months or 1 year, you would be tend to stop your SIP. Right, so that is I did it when I started 15 years ago. After a couple of years, I stopped a couple of my SIPs just because I thought this is not the right time to invest. Market is at peak, or maybe everybody is selling, so let's stop my SIPs. But that was a blunder. We should definitely avoid that. So anytime market is not in a good shape is the time that we should invest, right? So that you buy things cheap, you buy mutual fund units on a cheaper NAV. So that is why you need somebody who can handhold you and who can guide you in difficult times, in difficult market cycles, and so that you do not stop your SIP. Yeah, that's true. That's very important. So these were a couple of investing mistakes we should definitely note and do not repeat, do not this thing. Now let's talk about the long-term success. What we need in terms of in the investing career to achieve a long-term success, right? So that you can really create wealth over time. So yeah. So definitely invest systematically and regularly. We talk about SIP, the benefits and advantage of SIP. So be disciplined, continue to invest through whatever vehicle, whatever asset class you believe in, or your financial advisor advises you to go with the particular scheme. Let's do that, but continue to do that on a regular basis. It's not a one-day affair, and it's not an overnight, make quick rich program. So it's a long-term investing. If you heard this term carefully, always who are the honest money managers in the history, they always preferred and they always suggested investors to be patient and think long-term. So that is what our next point is: long-term perspective. Do not panic on the market downturns. Long-term investors ride out market cycles, and they benefit from the power of compounding, of course, because they stay course. They do not get out of the market to get the benefit of market. Diversify your portfolio. Don't put all the money in one kind of fund or one kind of asset class. Spread it in your investment based on your financial plan, your goals. Review your balances periodically. Review your portfolio. Talk and discuss. Spend some time meeting your financial advisor, understand what is to be done now. Is there any changes required based on the market cycle? And keep updated yourself with what is going on in my portfolio and even in the market side, so that you can do the changes with certain amount of concentration. And then, of course, not to be said, stay disciplined, manage your emotions. Successful investor resist temptation. Market is going high and we keep buying, but that's not how it should be. So do not make impulsive decision based on the fear or greed of the market fluctuations. Market will do its own thing. It's a collective wisdom, right? So market, who runs the market? So we run the market, and we means we, millions of people, right? So everybody has their own emotional decisions and many actions that we take. So it's a collective wisdom. So it will always fluctuate. It cannot be in a linear line. It is always relative, and it will all be ups and downs based on its cycle. So focus on your long-term strategy instead of short-term market noises. So yeah, of course, as you see on the last slide, the secret of a long-term success. Another way of looking into it is, as you consult your doctor or lawyer for various health and legal matters, you don't take your own decision, right, on a legal matter or something related to your health. Similarly, one should consult their finances with the financial advisor, because they know the best what is to be done now on a given situation based on your personal profile. So people only who are actively involved in the financial market and have time to research should invest by themselves. That is even my view. Anyone who does not have time or do not understand finances or business dynamics should get help from the professionals for the investment and wealth creation. So if you are ready to take control of your financial future, start by setting your clear investment goals, committing to regular investing through SIP. We already discussed, SIP is definitely a great way to begin. If you need personalized guidance, or if you have any question about mutual fund, feel free to get in touch with us and write your question in the comment on this video, and also follow us in YouTube follow our YouTube channel for more financial wisdom. And as I said, we are a financial services company. We are associated with Motilal Oswal Financial Service. We offer all financial product, including equity, mutual fund, bonds, your portfolio management services, AIF, insurance, everything that you can think of as a financial services we offer to our client. So we are also an AMFI registered mutual fund distributor. So any question you have, you can call on this number 70906441. If you like this video, please subscribe to my channel and help you understand finance better, and help me bring in new content, and which should be helpful to you. Thank you so much.